Okay, so it's second video about the average internal rate of return. Okay, already showing you how to get the IRR and then interim values implied by IRR. This is the main issue. I will put red, so you will remember this is the what I call the most weak part of the IRR. I think it's been raised by Boarding in 1935, and then you have another one, real estate appraisal. Can't remember the name, but that's in the 1976. Okay, so I will show you what happened. You have to remember that in the previous video already shown that there's a deposit. So this is what I call like a saving bank analogy. Okay, so you have a deposit, you have interest, and then you have withdrawal, and then you have a balance. Okay, right. Can I just put a bit color here, a bit light, if you want, and bold it, and then this one. Okay, and then you put in the mid. Okay, so this is the deposit. I will copy here, or you just link it if you want. Okay, and then for the period, I think the same for the year. I just link it, and then what's that? Okay, and then I just copy down. Hey, sorry, what I'm doing, I'm not too sure. Okay, it's just too much. Okay, and then you have this, and then as I said, this is 20%, so your balance is your deposit plus the interest that you get from the bank minus the withdrawal. In this case, you don't withdraw anything until the last part. So you're going to withdraw 1204. So it's pretty much the same with your the sell. We can say this is like a selling price of the project. Okay, at the end of the forecast period. Okay, so your interest should be your 10%. Okay, just copy it down here. Oops, your interest should be your 20% here at 4 times your, no, in the zero, in the initial year you don't get the interest, so just you can use if you want. With this 0, then it's 0, otherwise you use 20% at 4 times your beginning balance. Okay, and then you just write it down. Oops, it doesn't work. I don't know what's going on. Okay, just wait a sec. Okay, I don't want to know what's going on here. Okay, your deposit is minus. It should be positive because you put the money to the bank. So we don't need this 0. Okay, I have to make it positive, so it's -1. I just copy, and then I just copy here. You can put 0 because you deposit 0 here. Sorry. Okay, and then I just copy it, and then I just block this, and then and then you multiply that. Yes, and then you got. So you deposit 100, your interest, what's going on with this? Should be fine. Yes. And then your balance should be, oh, I'm sorry, this is not right. The previous balance plus the deposit plus interest, and then your minus your withdrawal. Goodness. Okay, have to use if this 0, then it is deposit, otherwise it's previous balance plus deposit plus interest minus withdrawal. Okay, just copy it down. Okay, cool, beautiful. So we have a balance zero. It means that we deposit 100, and then because you don't get interest in the year zero, in the initial year, so your balance should be zero. So this is make at end of period. Okay. And then in the second and the end of the first year, you invest 50, you got interest 20% from. So this is the interest is basically the IIR. Okay. Right. So I just have to move to here. So I just copy it here and then copy it down. Okay. So this is your interim value. The big problem with IIR, this is the big problem. I put in the red, so you go in and then I bold it. This is pretty much so basically IIR default to its interim period value, which is not correct since they are not market-based value, unless of course if the case is saving bank account. Okay, so for project finance model, for real estate finance model, this fixed or internal rate, internal period, interim period value are not always correct. Okay, have to remember that. Okay, I put the yellow here. Okay, so I just move here, and then actual market base. For example, we have like usually for the project finance or real estate, you have what call like an annual. What I'll put here the assumption. Okay, so I'll put this assumption. Okay, and then you have annual appreciation. So this is rate constant. I can put here like 37.2%. I use the same example as Magni and Schuller use that. Art Schuller use that. Okay, just change that a bit. Cool, I guess. It's not right. Just change this. Go wide. Okay, I can make a bit bigger. Okay, so we have one assumption here. Then I just put this is like a calculation. I copy it down and then I put here. So this is the calculation. Okay, you can put a bit bigger if you want, like 16, and then this is 16 as well. Okay, and then you have 32 points there. This is the input, so you can color it, or you can I don't know, you can put like a blue if you want. Okay, it's blue, always blue. I put like yes, I think blue. Okay, and then so first is the is this, if it's 0, then it should be 100. Otherwise, you use the previous. Sorry, I think we have to start with 100 first. If this is 0, then we start with 100. Otherwise, previous balance times 1 plus your annual appreciation F4, and then you close it. Okay, and then you copy it down. Hopefully it's working. Okay, so this is the actual market base, assuming the annual appreciation rate. Okay, and then your period appreciation is this one minus this one. Oh no, sorry. You can use if you want. This is 0, then it should be 0. Otherwise, this one minus this one. Okay. So just copy it down. Okay, and then the period it is A plus D S. Okay, you don't need 100 here. So just if this one is, sorry, it's a bit boring. Otherwise, it's this one. Okay, and then you just copy it down. Okay, and then the period rate of return is your E divided by your C, previous balance. Okay, so have to use this again. If this is 0, then use 0. Otherwise, E divided by your previous market. Okay, and then I just move it down and then put in the percentage. I'm not too sure whether it's correct or right, but let's see how to. Hopefully we can work it out. Okay, I'm going to move to the next video so that it's not quite long.